Silver is not rising, your money is collapsing. That sounds dramatic. But here's the contradiction nobody likes to sit with. People keep waiting for silver to cool off while ignoring the fact that the measuring stick itself has been bent. Since 2020, the money supply expanded by roughly 40%. That isn't volatility. That's a permanent change in the system. When the unit of value is diluted, prices don't cycle back. They re-anchor higher. On a screen, silver still looks manageable. In reality, it's being treated very differently. Governments are beginning to classify it as strategic. Banks are preparing to accept it as collateral. Industrial users aren't speculating on it, they're burning through it. And unlike gold, silver doesn't get stored and forgotten. Once it's used, it's gone. This matters to you more than most people realize. If you hold none, your purchasing power is being repriced against scarcity. If you hold some, liquidity may disappear exactly when you expect it. And if you're assuming this behaves like every past rally, there's one quiet detail in the data that makes that assumption dangerous. Because this isn't a run-up, it's a reset that doesn't rewind. What's happening now didn't start this year, and it didn't start with silver. The visible event is simple. Prices are moving faster, volatility is expanding, and more people are suddenly paying attention. But that's only about 60% of the story. The bigger pattern sits underneath it. For years, cheap prices trained markets to believe supply would always respond. If demand rose, production would follow. If prices spiked, they would fall back into line. That logic worked in a world where money was stable and capital was disciplined. That world is gone. The current move in silver is unfolding inside a system flooded with currency, starved of new supply, and increasingly dependent on physical materials to function. This isn't an isolated metal story. It's happening at the same time governments are running historic deficits, central banks are trapped by debt, and industrial demand is no longer optional. Silver isn't moving on its own, it's reacting to pressure from every direction at once. Here's the key reframing question. If prices are rising not because of speculation, but because the system can't function without the asset, what does fair value even mean anymore? Because once you see silver as infrastructure instead of a trade, the timeline changes completely. And this is where the first hard proof starts to matter. The claim sounds simple, but it's uncomfortable. This move isn't being driven by speculation. It's being forced by the structure of supply itself. Here's the fact. Roughly 75% of global silver production comes as a byproduct of other mining operations. Not from mines built to find silver, but from mines chasing copper, lead, or zinc. And in those operations, ore grades are getting worse. In many cases, yields struggle to reach 100 grams per ton. That means more rock, more energy, more cost just to get the same amount of metal. That's not a temporary bottleneck, that's a physical constraint. Now compare that to the outliers. In places like the Golden Triangle of British Columbia, there are intercepts reported at 467 grams per ton over meaningful widths. Those numbers exist, but they're rare. And their rarity is the point. High-grade primary silver deposits are no longer the norm. They're exceptions. Here's what that means. When prices were suppressed for years, the incentive to explore disappeared. Projects were shelved. Capital dried up. And now demand is rising in a market that quietly ran out of easy supply a long time ago. Notice what's missing from the conversation. There's no fast way to fix this. You can't flip a switch and create high-grade silver. Exploration takes years. Development takes longer. And silver, unlike gold, is being consumed, not hoarded. That's the pressure point. And once demand collides with geology, the timeline stops being flexible. Now watch how fast this escalates. When markets face shortages before, they usually show up as spikes. A few wild weeks, headlines, then a retreat. That's not what's forming here. What's happening now looks much closer to a normalization of stress. Something that used to be unthinkable is quietly becoming routine. There's a precedent for this, and it's not ancient history. In past commodity shocks, Prices surged because someone cornered supply or speculation ran hot. Think short-lived manias. This time the stress isn't coming from traders. It's coming from underinvestment that lasted so long it rewired the entire supply chain. Years of low prices trained producers to survive, not to expand. So now rising demand isn't met with new output, it's met with delays, deeper drilling, worse grades and higher costs. That's how a market shifts from cyclical to structural. Volatility stops being an event and starts being the baseline. Here's the part that should feel uncomfortable. Silver used to be treated as a hedge, something you owned just in case. But hedges don't get consumed. They don't disappear into electronics, energy systems, and infrastructure. Silver does. And when a material becomes both financially relevant and industrially essential, price behavior changes permanently. This is where the story flips, because once the system accepts higher prices as normal, the next pressure doesn't come from demand. It comes from stress inside the financial system itself. Here's the stronger proof, and it doesn't come from the silver market at all. It comes from bonds, specifically Japan's. In a single session, the yield on Japan's 30-year government bond jumped more than 8%. That kind of move isn't normal for a G7 economy. It's the kind of volatility usually associated with distressed markets. And it happened in a country with a debt-to-GDP ratio north of 200%. This matters because Japan isn't isolated. It's the largest foreign holder of U.S. treasuries, sitting on more than $1.2 trillion worth. When pressure builds inside Japan's bond market, policymakers face a trap: defend the currency by printing yen and fuel inflation, or stabilize the system by selling assets. And the most liquid asset they hold isn't domestic, it's U.S. debt. Notice the contradiction. Publicly, the system signals stability. Quietly, yields in both Japan and the United States are gapping higher at the same time. That's not coordination, that's stress leaking across borders. It suggests private buyers are stepping back, forcing yields up to attract capital that no longer wants to be there. Here's why this changes how you see silver. When sovereign debt becomes unstable, central banks lose room to maneuver. Intervention becomes unavoidable. And intervention means more currency creation layered on top of an already expanded money supply. This isn't theory, it's sequence. Bond stress forces policy response. Policy response weakens currency credibility. And when that happens, scarce physical assets stop behaving like trades and start behaving like insurance. And this is only one pressure line. Because while bond markets are tightening, geopolitics is pulling the system apart from another direction entirely. Now the pressure stacks, and it stacks fast. At the same time, bond markets are showing stress. Global trade is fracturing. Tariffs are no longer just economic tools, they're weapons. Disputes that used to stay diplomatic are now tied directly to resources, territory, and leverage. Even long-standing allies are being pulled into conflict over access to strategic materials. That matters, because trade friction doesn't stay in trade lanes. It bleeds into capital flows. Here's the next layer. European nations collectively hold roughly $8 trillion in U.S. equities and bonds. That's not a small position, that's systemic exposure. And when political alignment weakens, they don't need to sell aggressively to create pressure. All they have to do is stop buying. Demand vanishes quietly. Yields rise anyway. Stack that with a third development. Inside the United States, monetary and fiscal policy are no longer pulling in opposite directions. They're converging. The Federal Reserve is increasingly expected to support government financing needs directly, even if that means tolerating higher inflation. Growth is no longer treated as a threat. Rate discipline becomes optional. Each of these on its own is manageable. Together they create speed, less trust, less liquidity, more intervention, and every intervention adds more currency into a system already saturated. So ask the uncomfortable question: what happens if this continues? Because once momentum shifts from control to containment, markets don't wait for permission. Now bring it back to where this actually lands on you, because none of this stays abstract for long. You see it when everyday prices stop making sense, when electronics quietly cost more even as features shrink, when energy infrastructure gets delayed because one missing input holds everything up. Silver sits inside those systems, invisible but essential. When supply tightens, costs don't disappear, they move downstream. If you're holding physical silver, another reality shows up. Liquidity doesn't behave the way charts suggest. Local dealers get overwhelmed. Buyback spreads widen overnight. In some cases, shops go from paying a few dollars under spot to $10 back, not because silver lost value, but because cash vanished. That's not a market crash, that's a plumbing problem. And if you're watching from the sidelines thinking you'll step in later, timing becomes harder than it looks. Retail sellers rush in waves, refiners slow down, certain forms of silver suddenly become harder to move than others. Access matters more than price. If this feels familiar, say so in the comments. Because this is what systemic stress looks like at street level. Not panic, not headlines, just friction, delays, and rules quietly changing while everyone pretends it's temporary. But here's the part most people miss. These aren't random glitches. They're signals of how the system behaves when physical reality collides with financial abstraction. And once you see that mechanism clearly, the story stops being emotional. It becomes mechanical. Here's the mechanism that makes all of this possible, and it's quieter than people expect. The system runs on leverage, not abundance. Paper markets promise instant liquidity, infinite flexibility, and smooth pricing. Physical systems don't work that way. They move slowly, they bottleneck, and they break under speed. For years, leverage masked that difference. Futures contracts set prices. Inventory was assumed to exist somewhere else. Trust filled the gaps. But now incentives have flipped. Industrial users don't care about spot prices. They care about continuity. Governments don't care about efficiency. They care about control. And financial institutions care less about discovery than survival. When those incentives align, spectacle replaces transparency. Prices become signals, not truths. This is why you see contradictions everywhere at once. Paper prices that lag, physical premiums that don't, dealers widening spreads while global demand accelerates. It feels chaotic, but it's not. It's the system prioritizing who gets access when access is scarce. Here's the unsettling insight. Markets don't break when people panic. They break when rules change quietly and most participants don't notice. When settlement matters more than price, when possession matters more than valuation, that's how power shifts without announcements. And once that shift is underway, the question is no longer whether prices move higher, it's who gets caught on the wrong side of the mechanism. Because the next phase isn't about explanation, it's about trajectory. From here, there are two paths forward, and neither is clean. In the first path, pressure keeps building, but stays contained. Bond markets wobble, trade tensions flare, central banks intervene just enough to keep things functioning. Silver prices grind higher, not in a straight line, but in steps. Volatility becomes normal, pullbacks happen, but they don't reset the clock. They reset expectations. Each recovery establishes a higher floor than before. The system adapts slowly, awkwardly, and expensively. The second path is faster. One weak link snaps, a failed bond auction, a sudden halt in buying, a geopolitical move that forces capital to choose sides. In that scenario, repricing isn't gradual, it's abrupt. Liquidity vanishes where it's assumed to exist. Physical assets gap higher while paper struggles to keep up, not because everyone agrees, but because there's no time to debate. Notice what both paths share. There's no return to the old baseline. The difference is speed, not direction. And here's the part that matters most. Markets don't wait for confirmation. They move on anticipation. By the time certainty arrives, positioning is already done, which means the next move is forming before it's obvious. And once it becomes obvious, the window isn't wide. It closes quickly. Here's the insight that ties all of this together. This isn't really a story about silver. It's a story about what happens when a system built on promises collides with physical limits. For decades, value was abstracted, digitized, and levered. That worked as long as trust was cheap and resources were treated as infinite. Now both assumptions are failing at the same time. Silver sits at the fault line. It's monetary enough to reflect currency stress and industrial enough to expose scarcity. That's why it's behaving differently. Not explosively, but insistently. It doesn't need hype. It just needs the system to keep operating. The mistake most people make is thinking in reversals, waiting for confirmation that never comes, assuming today's prices are temporary because yesterday's system felt stable. But stability doesn't disappear overnight. It erodes until one day you realize the floor moved and nobody announced it. That's the loop to hold on to. If you want to understand where this goes next, how pricing breaks, how access changes, and how power shifts when scarcity becomes policy, stay here. Because this isn't the end of the story, it's the setup for what comes after. Follow for the next layer.